Hello traders, welcome to the LFB and our global video charting review. This is for February the 8th, 2011, and this is a look at the currency markets. Please be aware of the video disclaimer that is posted to the landing page on the videos, because we are looking for you to read the disclaimer before you view the videos. Looking at dollar index, since the non-farm payroll, we've had some bullish kind of undertones on the dollar index, not dramatic and certainly nothing that's able to break a midterm range. A lot of selling pressure still coming to bear on the US dollar, and the index that's made up by the euro, around 60%, by the Great British Pound and the Japanese yen, around 10 or 15% in either of those, by the Canadian dollar, which is just under 10%, by the Swedish krona and the Swiss franc that make up the difference. But what we have to understand very quickly about the dollar index is that it's overweight European currencies. You've got the UK, you've got the Eurozone, you've got Switzerland, you've got Sweden. Then the only two global currencies outside of those Europeans are the Canadian dollar, which is very much linked from an economic perspective to the ebbs and flows of what happens in the US, going both ways, good and bad. And then the Japanese yen, which is a poor reflection of the global currency market when you think of the stagflation problems that Japan has had over the last 20 years. So although it's a benchmark that you can look at as to where were you previously, it's probably in the dollar index a little bit dated now, especially in the instant technology, instant reward, instant information world that we now live in. It's a bit like reading yesterday's newspaper and trying to take something credible out of it when you're looking to other information sources that are keeping you 24 or 48 hours ahead of what you'd be able to read elsewhere. So although we refer to the dollar index, we don't rely on it too much. It's just a benchmark, an anchor point that we can look to say, okay, when we were last here, what actually happened? We do know that 78.50 is massive upside resistance on the dollar index. We do understand that literally this is just an inverted euro chart. If we go to euro dollar and we look at the euro against the dollar, you can see it's just like turning the dollar index on its head. So where the dollar index has got 78.50 upside resistance, the euro has got 3,500 as downside support. It's also where the 100-day simple moving average is at this point in time. There were some bullish movements on Tuesday in the euro, but if we look over the course of the last three sessions, we've gone sideways. We had 1 day of movement on February the 3rd. That was it. That was the precursor to the non-farm payroll. Literally no movement after that, and very little movement before that as well. Very much range bound, and in an environment where global equity markets are chugging higher, when hard commodities are moving higher, when soft commodities are moving higher, when interest rates look to be on the way up, you would expect the dollar index to have been able to have moved, and you would by default have expected to have seen euro dollar move higher. So there's some danger signals here. It's all about short-term signals at this point in time. We've just got a brand new long euro signal, but it's very tentative and it will have to close out this day. We're looking to buy the pullback on euro dollar. Another retest that comes back to 3,600 just consolidates and take the breakout from there. But as we've seen with those soft commodity charts, although the euro's moving sideways, you've got an awful lot of intraday volatility. For a commodity or an asset to be able to open and close at the same price takes quite a bit. But to open and close at the same price and have tested the previous session's high and low. Takes a lot to do on a consistent basis, but it just tells us that the market at this point in time is not ready to make a move on the US dollar that would take the dollar index below the 76 price point. We are at a triple bottom on the dollar index. We've been here 3 times in the last 4 or 5 months, and each time we've seen a test upside of 82, which would equate to a test on euro now coming down to at least the 32.50. So we need to be a little bit careful here, because history says if the global economy still has the outlook it does in regard to US debt, US economic growth, US employment, if it has the same outlook, if the global market has the same outlook as over the last 3 or 4 months, and there's very little to say that it should have changed that outlook, it's likely that the US dollar will get an upside test and euro will get a downside test of support. Nothing to do with the administration, nothing to do with the soundbite headlines, just literally that's what happened previously. And as a trader, you're looking to get the same circumstances, the same environment in the same place at the same kind of time frames, and look for history to repeat itself. So not that the euro looks bullish or weak, or the eurozone or the ECB is looking to do this or that. Just from a technical momentum flow perspective, it's going to take an awful lot to get euro back up to the 38.50 area, and the path of least resistance may be just a test down to 32.50. Oil's already going lower, but as we've said, those commodity markets, they're just trying to balance fair risk. You can't take a great deal of stock out of where those markets are moving. Looking at pound dollar, very violent on an intraday basis. This looks like a short wave radio frequency, very little movement that's sustainable. Every test of support and resistance over the course of the last 2 or 3 months on any given day has been reversed literally completely. Over the course of the last 2 or 3 months, I think I'm right in saying that there may have been only 5 or 6 times that Great British Pound against the dollar has been able to break the previous session's high or low and hold above that by the close of business. It really has been an incredible feat to watch this pair, as range bound as it is, but then on the 1 or 2 violent days break out and test upside resistance areas. But at this point in time, the market's not in to a heavy move on the pound that could take it up towards the 6,500. And again, by default, this just could mean a test of the 6,000 area before we go anywhere else. Aussie dollar impacted terribly from an economic perspective by the floods that are hitting one side of the Australian continent, whilst the other basks in a drought looking for water. It's been an awful period for the Australian people to absorb, and the Australian economy hasn't done too much to dampen the spirits of those looking to get long the Australian dollar. And the real bullish moves came from the last interest rate statement, which was at the beginning of the week before last, and the rate statement that was still very bullish on the Australian economy. But like the Great British Pound, on an intraday basis, this pair's just an absolute nightmare at this point in time to try and get a break and hold for anything other than half a session. It really is a very difficult pair at this point in time to get a handle on an intraday basis. Looking at dollar CAD, and again, you can start to see a pattern here. This heavy sideways consolidation, not able, like the Great British Pound, to make and break those moves, but CAD has been probably the less violent or the least violent of the major pairs at this point in time. Dollar Swiss, we've said for a long, long time, dollar Swiss is the precursor for a sustainable break. If you cannot get dollar Swiss to start moving, most of the other major pairs will not break their ranges. Now, we're still in a very tight sideways movement on dollar Swiss from the 2nd and 3rd of February through to the 7th when we started up again. This move higher on the Swiss franc against, or the dollar against the Swiss franc, is perfectly aligned to what happened to the 10-year Treasury yield. If you look at the 10-year Treasury yield chart, you'll see this is a perfect replication of that. Dollar Swiss and dollar yen are linked to the interest rate markets, and we've seen interest rates going higher as the yield on the 10-year note drop. As the yield on the 10-year note went higher as the note value dropped heavily. So this is in line with interest rates moving higher on that 10-year yield. Looking at dollar yen, and again a bit messy, the same as dollar Swiss. Very violent on an intraday basis for a pair with a very low trading range, but we've had a sideways slog on dollar yen for a long, long time. So in general, near-term signals, we would favour the long side of the dollar if you had to flick a coin and go that way, but we've got to understand that these global markets are suffering with short-term attention deficits at this point in time in regard to anything other than equity markets floating higher on the strength of the Fed's quantitative easing, where Treasury notes are bought back from the primary dealers. That spare cash is then being allowed to revalue books, should be put into equity markets that draws everybody else in. But the chink in the armour, the fly in the ointment, are that interest rates are creeping higher and the Fed can't afford, with the huge amount of debt outstanding to service, higher interest rates. Commodities have got raging inflation attached to them, and the Federal Reserve can't get the US dollar lower. Well, the US administration calls for a strong dollar policy. Well, this is anything other than a strong dollar policy at this point in time. So we're at a period in history, things are getting revalued. We will get back to a semblance of normality once these POMO operations are in place. But we also warned about the Thursday inflow. First one was last week, where the Federal Reserve's debt limit ceiling has now been hit, so the 56-day notes won't get rolled over. So every Thursday for the next 7 weeks, you're going to get another $25 billion hits the market to float equities higher as well. $50 billion minimum per week over the next 8 weeks minimum, that's going to hit these markets, that's going to float equities higher and leaves everything else in a state of limbo.